When it comes to specifically traditional standalone long-term care, who is a good fit for that type of product?
Right. Well, overall, you have to be fairly in good health. You have to be able to pass underwriting, and you're going to need to be at least under the age of 79. So those are all going to be important things. Your primary concern is long-term care planning, right? Again, you're getting the max amount of benefits for the least amount of premium. You are concerned about long-term care. So if you think you'll need care, this is something that you want to look at. If you're price conscious, if you're looking, again, for that maximum benefit, lowest premium, this is something to consider. Not looking for a guaranteed premium and you understand the possibility of having a rate increase, you have to be okay with that, then this is something to consider. And then if you have a smaller estate, you don't have assets to reposition, and again, it's got that partnership qualified, you're able to protect from Medicaid spend down, that's going to be important. And if you're a business owner, this is going to be something to consider because of potential tax deductions. So, Nick, let's take a look at a case study, okay?
I love case studies.
Okay, let's put this into real life. So, clients of mine, and we're going to call them Andy and Lori just to protect their privacy here. Andy and Lori are 55 years old. They're in average health. They live in Columbus, Ohio. They have 2 grown kids that are out of the house, okay? They are getting pretty darn serious about retirement. Right? They're really in that retirement red zone. They are serious about it. They have a combined income of $175,000. They've got a retirement already of $750,000, but they still have a mortgage of $250K. Why are they interested in buying long-term care insurance and having a plan in place? Personal experience, which is usually the number one reason I hear from my clients. They both have at least one parent that currently needs care, and they're actually helping to coordinate that care and help out physically occasionally. So they don't want to be a burden to their kids, and they know care is expensive. So they said, Kelly, we want to look at a solution where, again, we're getting the most benefit for the least amount of premium. We're in pretty darn good health. Can we qualify for traditional policy? And I said, let's take a look. So they did a pre-screen. Sure enough, they both qualified for traditional policy. So what we did is we looked at the cost of care. They are planning to retire in Columbus, Ohio. We looked at the cost of care. We looked at what they had. We looked at their concerns, and they decided that they were comfortable with buying a policy with a $5,000 monthly benefit. Okay, starting today, with coverage of 3 years each, with a 3% inflation protection rider and shared care. Also has partnership protection, okay? Which what that means is if, let's say, they spend down their assets and they have to qualify for Medicaid, what Medicaid will do is they will actually let you disregard assets dollar for dollar based on what was spent out in benefits in your long-term care policy. But again, it has to be a traditional partnership qualified policy. So let's say their policy had $200,000 that was paid out, Nick. They are able to protect $200,000 worth of assets and still try to qualify for Medicaid. Okay, as long as they meet the other qualifications for Medicaid. So that's the partnership portion of it. So with that $5,000 monthly benefit that we have, that Andy and Lori have, it's starting out at $5,000. Their total long-term care bucket year one is $180,000 each that they have in protection. They've got 3% inflation. In just 25 years, so at age 80, each of them are going to have, Nick, over $10,000 of a monthly benefit. And their total bucket each is $365,000 of protection. Again, they can dip into the spouse's bucket if they run out of benefits because we have shared care on there, which means they're able to use some of their spouse's benefit if they use all of theirs. And guess what their total premiums are? Take a wild guess.
I'm going to say 3,500.
What is that each total? What are you guessing?
I'll go with total. No, I'll say each. 3,500 each.
3,500 each. Okay, you're pretty close. So that's actually a total premium for both of them is $6,277. Okay, total, or $565 per month for that kind of protection. So we're saying that they are spending $6,200 a year, and out of the gate, they have over $180,000 each of a bucket of potential to pay for potential care. That's huge. right? The leverage there is outstanding. And then in 25 years, having over $365,000 worth of benefits.
And that's about the average time period when you see someone going on claim, right? I know maybe it's skewing a little bit younger, but I've seen, I think, some surveys that say maybe as early as 78 to 82 is kind of the average of when claims are happening.
Yeah, that's right. So typically based on claims, we're looking really about 80 to 85 in general is when we're seeing people go on claim. And so at age 80, you've got you can be guaranteed to know that I've got over $10,000 of income that's able to come in, because after all, we know that if you need care, it's really an income problem. Of course, it's a family problem. We know that, right, Nick? But it's an income problem. You could have tons of assets, but if you don't have income, how are you going to pay for that? And then if you have to convert those assets to income, there are often consequences, right? Tax consequences with that. So having that guaranteed income is really important. And so that's the kind of leverage that a traditional policy can provide.